Good afternoon, everybody. Welcome to the weekly wrap-up for May 13th, 2022. I hope everybody's having a great day out there and hope everybody had a pretty good week. Markets much better today if you're only looking at it on the one-day trends. But anyway, so if it's your first time watching, please give me a thumbs up, a like, a share, all that good stuff. I'm sure there's plenty of people out there who would like some no BS commentary on what's going on in the world. So let's go ahead and jump in and take a look and see how the markets did today. Dow Jones finished up 1.47%, closed at 32,196. The S&P 500 was up 2.41, closed at 4024. The NASDAQ, why is this popping up? The NASDAQ was up 3.82% as closed at 11,805. Small caps are up 3.63%. The VIX retreated 9.13% today. It's currently sitting at 2887. Still very, very close to that 30 number, which if you've been playing along and paying attention, anything over 30 is really dangerous, in my opinion. Moving over to the other exchanges here, Canada was up 2.03, Brazil up 1.39, Mexico up 0.78. Heading over to the European markets, Germany was up 2.1, UK up 2.55, France up 2.52, Euro stocks up 2.49, Netherlands up 2.82, Spain was up 1.68, Italy up 2.05, Switzerland up 1.25, and Portugal up 0.88. Moving on down, start to see some reds down here. The first red I see is Denmark. It was down 0.41. The Russian exchanges were mixed. The MOEX was up 0.42. The RTSI was down 0.69. All right. Poland was up 4.37%. Hungary down 2.27. Turkey was up 1.18. And Israel up 1.11. Saudi Arabia down. Israel down 1.11. And Saudi Arabia down 4.06. Heading over to Asia, looks like Japan was up 2.64, Australia up 1.93, New Zealand up 1.48. Heading over to China, the Shanghai was up 0.96, the SESE component was up 0.58, the China A50 up 1.08, the DJ Shanghai up 0.9, and the Hang Seng up 2.67, and the Taiwan weighted up 1.38. So, if we were to start the day in Asia last night, it looks like the Chinese and Japanese and other Asian markets are up, I'd say average, probably around 1.5 is what it looks like, just ballparking it. Western Europe, about 2.5 seems to be about the average for most of the European markets. And here in America, again, we already went over that. So looks like the Dow Jones was the least best performer at just under 1.5. All right, let's take a peek at this week's market and see how things did. Let's see here. Looks like the Dow Jones is going to finish up the week about 1.5% down. The S&P 500 looks like it's about 1.44. NASDAQ looks like it probably did down 1.03. Dow Utilities finished up the week down 1.07. And the Dow Transports finished up down 2.79. So it looks like all the major indexes here in the U.S. were down for the week, ranging from about one and change to the NASDAQ being, or I'm sorry, what was that, the NASDAQ? Or was that the Dow Transports? The Dow Transports down 2.68. So not the best week, unfortunately. It's not really surprising if you've been paying, like I said, if you've been paying attention. Let's come out here and look at the longer term trend. This is the Dow Jones. As we can see over the last week or so, we've broken back below this upward resistance line and are right back within this channel where we had been for really since the start of the year. So unless we buck this trend and start heading in a northwestern direction, northeastern direction. I don't see that we're going to be pulling out of this, longer term macro, downward trend that we're in right now. So, just and again, it's not just the SP or the Dow Jones. The SP 500 looks very similar. The Dow Utilities looks very different, and the Dow Transport, the Dow Transports looks different also. But the NASDAQ, again, looks like a very similar chart. If you start out at the beginning of the year, you drag it down, you can see where, we only had really one major uptrend in March, and it's pretty much been down most of this calendar year. All right. I think that is everything on that. Let's go ahead and dive into the economic data that came out this week. Shrink that down. The initial jobless claims came in this month at this week at 203,000. The forecast was 195. So this is the second week in a row we've been above 200K for initial jobless claims. First time, the last time we were above was end of March. So all of April, we were 166, 185, 184, and 180. But it has ticked up slightly here in the last couple of weeks. Continuing jobless claims came in at 1.343 million. The forecast was 1.380. So that's, let's see, last week's numbers were revised up 3,000 from 1.384 to 1.387. So again, we're still in that same range we've been in for a while, which looks really, really good. Moving over to the U.S. Consumer Price Index, year over year, we came in at a 8.3 number. It did retrace a little bit from last month's 8.5, but still really, really, really high. And if you look at the month over month numbers, you don't see a lot of lines below, or we don't see a line below the midpoint since June of 2020. So, what I'd like to see, while we would like to see a reduction in the year over year number, until we start really seeing some consistent months where prices are, actually retreating. I really don't see any inflation relief. And actually, I created, what I did was I went into went in and pulled all these monthly inflation numbers going back to the first positive number we had for July of 2020 and added those up. And they add up to, since basically, 22 months now, inflation for total for the CPI is up 12.3% since all this madness started. So we would have to go down quite a bit to even get back to break even, before all this, all this inflation started and money creation. So, until we get, closer to that number, I am not really impressed with what a lot of the people at the Fed are talking about. The producer price index year over year came in at 11%. Did pull back a little bit from 11.2 the previous month, but again, prices, and what these are the prices that the people you buy goods and services from, whether or not cell phones, whatever it might be, they're paying 11% more for their goods to put your crap together. And so they're passing that along to you, unfortunately. The month over month number, again, we haven't had a negative month since July of 2020. So we have nothing but consistent months of upward numbers. And actually, let's take a look here and see what that would look like. Going back to, let's see what the total inflation is on this one. So let me create another sheet here. All right. Equals some. All right. And our gross inflation number on producer prices is sitting at 14.7% over the last 22 months. So again, not real good. All right. The U.S. Consumer sentiment came in at a 59.1 number. Forecast was 64. So quite a ways off from where the forecast was. And you can see, really the last was since August of last year. Let's see. Yeah, basically over the last 10 months, it's been a pretty consistent slide down from the 80s down into below 60. So again, not excellent. All right, let's go ahead and run through a few articles here. I'm going to try to keep this brief. I've been rambling only for 10 minutes. I'm making good time so far today. All right, let's see. S&P 500 jumps as tech emerges from recent beatdown. The S&P 500 surged Friday as tech stocks staged a strong rebound from their recent rout as dip buying appetite returned despite further evidence that inflation is hurting the consumer. Growth sectors of the market, including tech, flourished after a recent sell-off appeared to entice bargain-seeking investors back into big tech, with Amazon, Google, Meta leading the charge. The return to favor of tech stocks has many questioning whether this is a short-term relief rally that could soon fade. I would agree with that. Or is this the start of a more sustained move to the upside? Looking at the charts we just looked at, would that tell you that? Nope. Quote, I think most of the damage has been done in the stock market, but I wouldn't expect a big snapback to recover all the recent losses, end quote. Sean Bonner, founder of Guild and a former U.S. Navy veteran. Hey, I'm a U.S. Navy veteran. No one asked me for my opinion on anything. Said in an interview with investing.com on Friday, flagging the threat of further upward surprises in inflation, which could further impact consumers. Quote, Ukraine is often referred to as the breadbasket of Europe. If a big portion of that is taken offline, there could be more inflationary pressures on food commodity stocks, which will affect U.S. PPI and CPI, Bonner added. U.S. consumer sentiment on the economy in early May stooped to the lowest reading since 2011. The University of Michigan Consumer Sentiment Index showed Friday. Twitter, however, bucked the trend higher, falling more than 9% after Elon Musk said he would put his takeover of the social media company, quote, temporarily on hold, end quote, citing concerns over fake accounts. The Tesla chief executive, however, affirmed that he was committed to the take private deal. I hope so, because I'm tired of all those whiny woke people who freak out every time someone says something they don't like. Twitter CEO Parag Agrawal said that he expects Musk to follow through on his deal to buy the company. Consumer discretionary stocks are also involved in the heavy lifting of the broader market, supported by a surge in reopening stocks. Las Vegas Sands, Wynn, and Norwegian Cruise Line were the top gainers in the sector. Energy, meanwhile, continued to ride oil prices higher amid the tug of war between weaker demand and lower supplies as the war in Ukraine rages on. Yeah, I'm sure it's a big deal. In other news, Robinhood markets surged nearly 24% after Sam Bankman-Fried, the chief executive crypto exchange FTX, acquired a 7.6 stake in the trading platform. So again, if you just looked at today's market, you think, hey, things are great. They're not. All right. Next article, oil jumps 4% as U.S. gasoline prices hit record high. Stock market soar. It's written by Scott DiSavino from Reuters. Oil prices rose about 4% on Friday as U.S. gasoline prices jumped to an all-time high. Stock market soared on fear supplies would tighten if the European Union banned Russian oil after Moscow sanctioned European units of state-owned Gazprom. Brent futures rose $3.97 or 3.7% to $111.42 a barrel. WTI crude rose $4.38 or 4.1% to $110.51. U.S. gasoline futures soared to an all-time high, boosting the gasoline crack spread, a measure of refining profit margins, to its highest since it hit a record in April of 2020 when WTI settled in negative territory. The U.S. 3-2-1 crack spread, another measure of refining margins that includes both gasoline and diesel, rose to a record, according to Refinitiv data going back to May of 2021. Automotive Club AAA said U.S. pump prices have risen to record highs of $4.43 per gallon for gasoline and $5.56 for diesel. Awesome. I drive a diesel truck. WTI was on track for the highest close since March 25th and its third weekly rise. Brent, however, remains set for its first weekly decline in 3 weeks. Oil prices have been volatile, supported by worries an EU ban on Russian oil could tighten supplies, but pressured by fears that a resurgent COVID-19 pandemic or other factors could cut global demand. Quote, an EU embargo, if fully enacted, could take about 3 million barrels per day of Russian oil offline, which will completely disrupt and ultimately shift global trade flows, triggering market panic and extreme price volatility, said Rystad energy analyst Louise Dixon. This week, Moscow slapped sanctions on the owner of the Polish part of the Yamal natural gas pipeline that carries Russian gas to Europe, as well as the former German unit of the Russian gas producer Gazprom, whose subsidiaries service Europe's gas consumption. Pressuring oil prices during the week, inflation and rate rises drove the U.S. dollar to near 20-year high against a basket of other currencies, making oil more expensive when purchased in other currencies. The EU said there was enough progress to relaunch nuclear negotiations with Iran. Analysts said an agreement with Iran could add another 1 million barrels per day of oil supply to the market. So yeah, it's a mess out there when it comes to energy prices. One thing, and I have no confirmation of this, but some of the rumor mills that I've been hearing is that Russian boats or cargo ships with oil will go out into the ocean, hook up with a European vessel, pump all the oil into the European vessel, and then they'll bring that boat back to Europe. And now you have oil. It didn't come from Russia. It came from middle of nowhere. It's a mystery. It's a mystery. So, like I said, I have no confirmation on that. It's just some of the scuttlebutt I've been hearing from some of the places I listen. All right, last article I got here: how we all can beat inflation by Rick Newman. Is the 8.3% inflation too much for you? Want to do something about it? Well, you can. Simply stop buying stuff. Well, that's a very good piece of advice. The current spate of inflation has several causes, but inflation by definition is a rise in prices when demand exceeds supply. Well, technically, the definition of monetary inflation is increasing the money supply. Price inflation is when you have too many dollars or whatever form of fiat you're using, chasing too few goods. So like in the last 2 years, we increased the money supply by 40%. We pumped all that money out in stimulus and other garbage, and so people have more money in their pocket, but there's still the same amount of goods or less because of supply disruptions and everything else that's been going on the last 2 years. So if you have the same 100 Ford trucks and people have 40% more cash sitting in their pockets, people bidding for those goods, it's going to push prices up. So all right. There's a lot of arguing these days about why supply is tight. Maybe it's because President Brandon wants to rein in fossil fuel production. Russia's invasion of Ukraine certainly hasn't helped. COVID lockdowns in China are still snarling supply chains. The microchip shortage persists. But that's supply side. But if demand were lower and supply stayed the same, prices would fall and inflation would be less of a problem or no problem at all. There are obviously some things we can't stop buying: food, baby formula, gas to get to work, energy to heat our homes, and other necessities. But a lot of what Americans buy doesn't qualify as a necessity. And those splurges have intensified during the last 2 years as COVID has forced millions to spend way more time at home. Inflation is an obvious hardship for people living on tight budgets, but there are at least 40 million Americans living large with plenty of money to spend. As the New York Times pointed out in a recent article, they include homeowners whose biggest assets has soared in value during the last 2 years and investors whose stock portfolios have swollen even with recent market declines. Those spenders have fueled a boom in personal consumption, and that's a big contributor to elevated inflation. From 2010 to the beginning of 2020, the average monthly increase in personal consumption from the year before was 3.9%. For the last 12 months, the monthly increase has averaged 14.2%. That number is somewhat exaggerated because some of the year ago baseline numbers were depressed on account of the COVID downturn. Even so, personal consumption grew 9.1% year over year in March after rising 12.3% in March of 2021. That tells us turbocharged spending is much more than a numerical phenomenon and extends well beyond federal stimulus payments that goose spending in 2020 and 2021. There's plenty of anecdotal evidence that a lot of consumer spending is discretionary rather than essential. Home remodeling sales at Home Depot and Lowe's have been very strong, and Bank of America's forecast, quote, better than expected industry trends, end quote, this year. Those are mostly nice-to-do projects, not staples. Some categories with high inflation are essentials, such as household gasoline up 44% year over year, household energy up 16%, food up 11%. But other categories represent purchases people could put off if they had to, such as furniture up 15%, new cars up 13%, and appliances up 8%. You can see here on this chart. Let me make it bigger for you so you can see it. Gas, all of these things. Let's see, above 10% are rental cars, food, new vehicles, furniture, household goods, or household energy, I'm sorry. Hotel rooms, transportation's up 19.9%, used vehicles up 22.7%, airfares up 33%, and of course, gasoline up just under 44%. All right. Travel is also a new source of inflation, with airfares up 33% year over year, hotel rooms up 20%, and rental cars up 10%. Some travel is essential, but much isn't. Isn't actually good news that demand for travel is driving prices up. That will help one of the hardest hit industries to recover, and also shifts some consumer spending away from goods, which could bring down elevated prices. It also tells us Americans are optimistic enough to pay higher prices for travel after 2 years of COVID frustration. Time for demand destruction. If there were a concerted national effort to postpone non-essential purchases, it would prompt perhaps a dramatic effect on inflation. This is a wistful thought exercise, however, since there is no chance that will happen. Americans are not in the habit of sacrificing for the common good, and if President Brandon were to even suggest it, the mockery would be deafening. Yes, I would be mocking a man who has never held down a private sector job and has been living and sponging off the American people his entire life. Yeah, I would mock the hell out of that guy. One of the benefits of Brandon's advanced age is that he was actually in government in 1979 when President Jimmy Peanuts asked Americans to consume less. The last time a U.S. president has been naive enough to make that mistake. Yeah, Jimmy Carter's an idiot. The ultimate solution to inflation, however, is a recession, because people suddenly worried about money stop buying stuff. Quote, demand destruction, end quote, as economists call it, isn't a binary thing that happens only during a recession. It's an incremental thing that happens all the time and is undoubtedly happening now as consumers make mostly rational decisions to buy less or substitute cheaper stuff as prices rise. You can't do that with everything, but even if demand falls back at the margin, it can make enough of an impact to bring down inflation. This has happened during every recession in post-war history, as the chart below shows, with the recessionary periods shaded in gray. In July of 2008, for instance, inflation hit an unusually high 5.5%, driven largely by surging oil prices. But a recession was already underway, and a year later, inflation had turned negative, with prices falling by 2%. During the stagflation of the 1970s, double-digit inflation helped trigger recessions, yet price hikes decelerated sharply in the aftermath. The Federal Reserve is trying to cool off the economy by raising interest rates without going as far as to trigger a recession. Yeah, they're not getting out of that one. I would put it at greater than 75% odds that we will head into recession at some point, either this year or next. I don't have a crystal ball on when that's going to happen, but it is pretty evident we're going to have to go through that business cycle. Higher rates suppress consumption on their own, because debt-fueled business and consumer purchases become more expensive, so there's less of it. The jury is out on whether the Fed can engineer a, quote, soft landing. Yeah. Remember the video we saw the other day with all those plane crashes? Yeah, that's what it's going to look like, probably. That would bring down inflation while keeping the recovery going, but spending and prices will come down one way or another. We could cut spending preemptively, but we're more likely to do it because it suddenly feels uncomfortable parting with our money. And that's probably the truth. Unfortunately, I mean, it's kind of like retirement planning. Most people don't start doing it when they're in their 20s and 30s and 40s. They wait till they're like 60 and they're like, holy crap, I need to figure out how much I need to have saved by the time I retire in 5 years. And oh, I live on $150K a year and I've got 2 years worth saved up. Yeah, it's not going to work out that way. The best time to plan or to prepare for an event is far in advance. It's kind of like hurricane preparation, or like out here where I live, there's fires everywhere right now because of the high winds and the dry weather from the La Nina. It's the time to clean up your property and get all the brush off is before the fire comes. So something I actually need to do. So over the next couple of weekends, I'll probably be out collecting all the dead branches off the ground. So anyways, all right. Well, hope everyone got something from this. I always try to provide a little bit of value and some insights on what's going on in the world. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Book a meetings, drop me an email. If you need to give me a call, all my phone numbers are there too. So hope everyone has a fantastic weekend. Go out and get some sun, watch some Astros baseball. They've won. Don't want to say it too loud because every time I bring it up, I seem to jinx them, but they're playing really well. And that guy Pena, Carlos who? I don't even remember who that Carlos Correa guy is anymore up in Minnesota. So it looks like that deal worked out a lot better, and we didn't have to pay $35 million. I don't. I have no ownership stake in the Astros, but it saved Mr. Crane. I mean, I'm probably paying Pena. I haven't looked it up. He's probably making $200,000 to $500,000 a year. I mean, that's a $34 million savings. So anyways, so like I said, go out and have some fun. I'll be back on Monday with the weekly economic update and any news that happened over the weekend. So y'all take care, and I'll see you then.